Hello viewers and welcome to our Meridian Australia webinar. Today we're going to be talking about the future of the property markets in the current climate of COVID-19. Now, before we get started, I'm just going to go and do a quick disclaimer. This presentation is to be considered as general info only and not to be taken as a substitute for specific advice. Now, with that one out of the way, I just thought I'll introduce the speakers for today. I myself, Bradley Wern, am the Head of Research at Meridian Australia. I'm also the General Manager. And today I'm joined by my colleague, Senior Investment Consultant, Jared Gauzy. Jared.
Hey guys, hope you're all well. It's great to be here and we look forward to going through all this evening's content. I believe you'll take a lot of value away. Me personally, I've been investing since 2008 and I've been fairly active in that time and hit some key milestones. And with the team at Meridian, I'm coming up to 5 years where I've been working side by side with my clients, helping them select markets for residential property investment and building their portfolios. So we look forward to this evening.
Fantastic. Okay, we're just going to go through a brief overview of what today's presentation entails before we get stuck in. Today we're going to be going over the economic impact on the market as well as some of the areas to avoid in the current climate. We're going to talk about the sector of economies that are worst impacted by the COVID-19 crisis and the subsequent, grinding to a halt of the employment sector and I suppose business overall as a whole. We're going to talk about the government response to the situation, both the health crisis and the economic crisis as it continues to unfold. We're going to determine what actions have been taken, the response and to date of what that looks like, and we're going to talk about, do we think it is sufficient in its response there. And lastly, what we're going to go through is BIS Oxford Economics revised city forecast. So BIS Oxford Economics, been around for some time now, and actually a member of our investment committee there. So as the situation continues to change in each and every day, it's rather dynamic in nature. We do bounce off BIS Oxford Economics to get update on their forecast there and what the impacts of some of the decisions that are being made by government are going to have. And lastly, at the end, there will be a screen there. Just for anyone that has any questions, you feel free to submit us an inquiry there through the email link at the end. And yeah, that out of the way, let's get stuck into it. Okay, the economic impact on the market. So just looking at this particular slide here, this illustrates the impact on GDP on the Australian capital cities and some of the regional areas as well. So we've been hit by two unprecedented crises that have battered Australia over the last 6 months, being the COVID-19 pandemic, and also we're still recovering, so to speak, from the impact of those catastrophic bushfires, which only happened not so long ago, just towards the end of last year and the start of this year. The subsequent economic decline across Australia is both considerable and varied, but what history does tell us is that economies can bounce back quickly after a severe downturn. So a quick recovery is possible, but not uncertain. So looking at the graph there, if we take particular note to Sydney, you can see that Sydney City, the CBD, is lost between 10 and 12.5% in GDP output. And if we look at Melbourne CBD, respectively, it's quite similar, with 10 to 12.5% of GDP expected to be lost in the year to where we stand today in 2020. Now, combined, that's 20% of the national GDP output, which is quite substantial. Now, things to consider there, the areas that are impacted most significantly are the CBD areas, the areas surrounding the airport precincts, the tourism centres, and also the areas that have been impacted by bushfires. So obviously there's been quite a substantial decline in GDP output there, just as a result of the isolation measures and the restrictions of being able to trade there. Is there any input there at all?
Look, I'd just like to say, look, we're going to go through the government stimulus that's been put out in the last 8 weeks in relation to COVID. And there is some alarming statistics there, but in saying that, it's been good that we've been able to keep it to those numbers. It could have been far worse, and we're going to go through the stimulus that's been able to keep it to these numbers, which is the positive side to this.
Yeah, 100% correct there. So Australia has made some good progress at stopping the spread of COVID-19 virus. The community transmission rates is down significantly. The recovery rate is up significantly. The new cases are very low, in the single digits now, I believe. So the consideration is now turned to reopening the economy. But the health risks are easing, but the economic risks have been rising. So it's a case of finding some balance there. So before we start delving into the response, we'll better take a look at what's happened to the economy and the job sector there. So this graph here, it really illustrates what's happened in the workforce. So recent labour force data gives us our first real glimpse into the impact of COVID-19 and how isolation measures have impacted upon the employment rate. Looking at this graph here, it's plain to see that one of the most impacted areas and service areas is the accommodation and food services industries. Now, clearly these services do not have the ability to work from home, and therefore they're reliant on government support. Now, at the same time, other sectors have also been impacted. While job losses are not as substantial, the impact is seen in hours lost and the decline through output. So this graph here, if we're looking at the blue bar, that's the jobs losses that have occurred between the 14th and the 18th, 14th of March, I should say, and the 18th of April. And the red line there is the loss of wages. So when we're looking at accommodation and food services, as you can see there, they've had a substantial loss of jobs, and the wages are, not far behind. Whereas if you compare that with something like the financial services sector, the job losses have been minimal, but the wage losses have been substantial there. Now, we're going to take another look one step further and take an in-depth look at what else is happening there in these labour market assumptions that have come out. So at the top of the graph here, the numbers there are for the employment of quarter one in 2020. The second column there is the proportion of the workforce that are employed on a casual basis. The third column, which is quite interesting, is the projected job destruction or job loss due to the restrictions. And the last column there is referring to the increase in unemployment over the period. So unsurprisingly, when we take a look at household services, for example, if you look at the third column there, it does have the largest projected job destruction due to the restrictions at 76.4%. And at the same time, it also has the highest proportion of casualised workforce as well, which is quite interesting there. So you're probably thinking, oh, what is a household service, or what is some of these services, what do they entail? We'll get to that in a second. But if you also have a look at some of the other industries there, we'll see that the third one from the top, goods and retail distribution, that is also expected to incur a loss of 40.7% due to the restrictions, and it also has a rather high proportion of casualised workforce there at 26%. So household services, how we can kind of gauge that is actually this graph here, which kind of shows the change in consumer spending. Now, a lot of these are actually household services. So if we take a look there, Jared, do you just want to give us a bit of a run through this one?
Yeah, absolutely. We had to, it was almost 6 to 8 weeks ago that we had the closures, and you had to close gyms, entertainment, public transport basically shut down altogether because everyone's staying home. So the expectation was to see these numbers rise, but it's had its positive effect, and with obviously the cases reducing. And what we did see was spikes in certain industries. As you can see down the bottom there with food delivery, for instance, with more food and businesses adapting, especially in the food sector and accommodation. Food is obviously been booming with the deliveries. How you see the top one down the bottom with plus 156%. Now, what we'll continue to do moving forward as the weeks go on, and now that the doors will open tomorrow on the back of the government plan, we're going to see cafes reopening. And then hopefully 3 weeks' time, we'll see gyms reopening as well. What we'll tend to see is these numbers improve. So in 3 to 4 weeks' time, we look forward to revisiting these numbers and sharing that information with our investors.
That's correct there. So at the bottom of that graph there as well, you will notice that there's been a bit of a spike in furniture and office equipment. So with the transition to some people working from home, there has been an uplift there, which is quite interesting to see. Obviously, that cohort there is going to be more linked with jobs in the professional and services sector, and those people that do have the ability to work from home, whereas conversely, gyms, cafes, restaurants, bars, clubs, and all the rest of it don't have that ability then. So what we're going to do next, well, before we move on actually, it's probably appropriate to point out that with the government's roadmap to reopening the economy being announced, which we'll go through later, the whole strategy is really contingent about consumer spending bouncing back and encouraging people as business reopens up, as confidence improves, to start resuming daily life and participating in all these services. So they're getting back to the gym, starting to go back and go out for the weekly outing at the restaurant or the cafe, and eventually when we get to the last part of the plan there of even going back to the pubs, the clubs, and all the other activities there. So what we're going to do now is we're going to take a look at the heat map. Now, this particular map shows us the economic impact on GDP growth at a suburb level. So some regions with significant mining and agricultural industries, for example, would be less impacted by social distancing restrictions, and they've kind of had some levels of GDP growth, which will be shown there in the blue. But many of the local government areas have experienced, between a 2.5 and a 7.5% decline. So when we're looking at that heat map there, a lot of those local government areas that rely on tourism, for example, they're likely to have experienced between an 11 and 15% decline in GDP as a result of travel restrictions and closures of the airports, and the loss of income through the retail sectors that are attached to the airports. And generally speaking, there's a lot of entertainment and shopping precincts and tourism icons are near and around the adjacent CBDs, which are located in close proximity to the airports, particularly in Victoria and Sydney. Also, you'll notice that this particular heat map also factors in the impact of the recent bushfires, which could see up to a 20% decline in annual GDP. But what we're going to do now, we're just going to take it one step further. Looking at this particular, we've just zoomed in here on this map, and this just highlights it. So the areas that have been impacted the most, as I said, are the CBD precincts, the airport precincts, the tourism precincts, and also the bushfire precincts. Now, for anybody that actually wants to view their specific local government area or interested to see what the impact is in change of GDP over the period up until present, we actually do have a link to an interactive map where you can zoom in and view your own, in particular, local government area. So if that's something of interest, please feel free to shoot us an email there in the comments section, and we'll definitely be able to provide that to you.
Yeah, absolutely, Brad. Like, this interactive map can really give you some understanding of any potential markets you're looking into and the impact on the GDP of that markets. We actually reviewed a recent ABS survey of changes in employment on the back of this COVID conditions, which found that a substantial 25.6% of jobs have been lost in the accommodation and food sector. So it's to no surprise that, as pointed out on this map, it's towards the inner CBDs of certain markets. But looking at that interactive map, that can reveal if there's too much exposure to any one sector and give you a bit of foresight into potential property markets that you look at moving forward as we leave COVID.
That's 100% correct there. So having a look at that map there and just bearing in mind some of the areas that are most affected, well, what we'll do now is we'll just move forward and take a look at the policy response from both the federal government and the Reserve Bank, just considering what we've just looked at then. So, Jared, if you just want to run us through the salient points.
Absolutely. The key 3 points I wanted to touch on, and we've got to give the government a pat on the back for this. It's really helped keep the unemployment rate down and not escalate as far as it could have. So the first one was the economic package of $17.6 billion, which was support cash flow and investment spending of business and provide payments to vulnerable Australians. So that was the first response. So $17.6 billion is a lot to be forking out, and it's had great positive effect as a whole on our economy. Now, the second stage package that we looked at and that was released by the government was $66 billion. And that was obviously what we're aiming to do is keep businesses active and working and keep workers in their jobs through this period. 8 weeks in, we saw recently the third package, which most people are well aware, which was the JobKeeper program. Now, this was huge. This was $130 billion that's keeping people in employment and, will help us weather the storm of COVID and really make us re-enter to normal conditions sooner rather than later. Now, if that program alone, the JobKeeper, wasn't put into place, the expectation was to see unemployment rise higher than 15%. Now, the expectation that it has been put in place, it's going to keep it to hopefully 10% or less.
Yeah, that's correct, Jared. So just to reiterate, the 3 successive government packages there have been designed to support people that have been loss of employment through termination, and the introduction of the JobSeeker program has been designed to keep people employed, even if there's been a wage loss. By keeping people employed and in work, it's expected that when the government plan unrolls and unfurls and business reopens, that they can hit the ground running as opposed to incurring all the costs associated from starting from scratch, so to speak, trying to re-engage and rehire staff and build that momentum. So as Jared's highlighted there, it could have potentially have seen the unemployment rate escalate to 15%, whereas by the end of June, it's only forecast to hit 10%. So quite substantial there, the impact. Part of the stimulus packages have also been announced. They've been aimed and focused around supporting some of the most at-risk industries, obviously the airlines, airports, tourism, they're quite a substantial one. But at the same time, even directing some funds towards some of the more vulnerable communities. So there's been some money dedicated and set aside to aged care support, education relief, and most importantly, to support the frontline effort of healthcare workers in terms of ramping up testing, identifying potential people that any new clusters, and also just, I suppose, preparing for any spikes or any future escalations that may occur as the isolation measures are unwound and relaxed. So it's kind of to be expected, so to speak. But so far, the government response has been quite strong, and it's expected that the state governments will also announce individual packages on the back of this as well. And we expect to see more and more of this come through over the coming days and even weeks as the health response continues to unfold. Move forward. Okay, so this particular graph here, this just outlines the GDP growth outlook beyond COVID-19. Now, what we're looking at is the average GDP growth in the 3 years following the end of a recession. So we've had 8 recessions in the last almost 100 years, I would say. Over the last century, there's been 8 events where the annual GDP has declined in Australia, and these are all shown here. The only 2 events which probably come close to the likely impact of the COVID-19 situation would be the First World War and the Great Depression events. In 1914 to 15, the GDP fell by about 11% due to the onset of World War One. This brought about a dramatic fall in global trade, similar to what's happened with COVID-19, albeit that was due to the war effort, people enlisting, as opposed to the current situation, which is social distancing there.
Yeah, positive signs there, Brad. We've had some strong rebounds, and considering all that government stimulus we just touched on, gives us a lot of positive signs moving forward out of COVID. Considering that as of tomorrow, we're going to open the doors to more businesses, more dollars will be coming into the economy, more people will be spending money, and that's just going to, in a real estate sense, that will help improve consumer confidence as well.
That's it. So it's envisioned that hopefully if the economic response, and we get it right, and also the COVID-19 situation continues to improve, and Australia's been quite good. We've been a world leader in terms of testing and management of the disease. It's likely that we can expect to see a resumption of GDP growth levels similar to what we've seen here now. I suppose another comparison could be similar to what the Spanish flu, the performance did in the 3 years following the Spanish flu epidemic there, which is GDP in excess of just over 8% there. Okay, Jared, did you just want to run us through some of these scenarios?
Yeah, absolutely. If you just pull up 1 and 2 for me. Thanks, Brad. Yeah, absolutely. Look, we've got to be careful of the headlines that are out there about property prices plummeting and cracks appearing. But without a doubt, transaction volumes did decrease in the last 8 weeks, which is obviously expected. In times like this, we saw obviously social distancing. We had to stop auctions. We had to stop proper open homes. So, of course, people are sort of going to sit on the fence and wait until those conditions return to look to sell their property. Now, it doesn't mean that property values are decreasing, and we're going to go through some numbers shortly that express what's really been taking place. But a drop in listings can assist the market because there's less supply in the market. Because what we need to consider with an epidemic such as this, obviously underlying buyer demand will reduce because less people will be buying because they want to see what's going to happen over the coming months. Now, we have got through the worst of it, I believe. And what we're starting to see now is listings increase weekend on weekend, which is great, but not too much all at once. There hasn't been a glut of listings, which is great, because we do need to consider that, we're not out of the water yet. Things are improving. But we are seeing listings increase, which is the positive sign for the property market. And it's now coming up to the second weekend that we're looking to take auctions, property auctions, as well as normal open homes again. And that is going to improve conditions overall. Okay, so moving forward, if we look at price growth and what's actually been taking place.
Okay. Take away, Jared.
Yeah. So look, this is obviously CoreLogic. This is the monthly results. We look at this consistently and provide feedback to our clients of what's taking place. And if we look at the past month alone, Australia saw 0.3%. So look, there's some resilience there, a sense of resilience. And despite a decline in momentum, values largely have not yet fallen into negative territory. And this is because we have a robust market. Property is a slower moving and more stable asset class. Much different contrast to what we've seen with shares over the last 8 weeks, where there's been some dramatic drops. So positive in that sense. If we look at the past 12 months, and look at Sydney, Melbourne, Brisbane, as well as Hobart and Canberra, when the conditions are right, we can see some really great solid returns. And so moving out of COVID, as we start to enter this next phase, which starts tomorrow, and we're opening doors to more cafes and restaurants and businesses reopening, sentiment will improve. So there's no doubt if you're selecting markets that have low supply, keep in mind we're in the lowest interest rate environment that we've ever experienced. That's only going to help buyer activity moving forward, and sentiment will continue to improve as we move along.
That's correct, yeah. So the demand side of the equation is what's being removed through this COVID-19 situation. However, as the economy begins to reopen up, we expect sentiment to improve significantly, and at the end of the day, people still need to live somewhere. So that desire hasn't gone away. And at this time, what we've been seeing as well is property agents have been quite quick to adapt. So they've been changing their practices as well. So changing open homes to do virtual tours, and taking very limited private appointments and inspections. Over the period as well, what we have seen is auction volumes have declined for a couple of reasons. We've seen the withdrawal of auctions and they've been replaced in favour of private treaty. They've been sales via private treaty, and at the same time, just given the uncertainty of what's been happening, as well as we've just had prospective sellers just withdraw their listing altogether and choose not to proceed with the sale, and just kind of sit on their hands until they wait and see how the situation plays out. And once there's a bit more certainty, we'll probably see those properties, potentially put back on the market for sale.
Yeah, absolutely. We look forward to revisiting these numbers in 4 weeks' time, because then we'll have a solid 6 weeks of normal auctions and normal open inspections, which is only going to help improve activity.
Okay, that's an interesting one. So obviously we've seen the impact on the sales volume, sales values, or the dwelling prices here on this particular graph. But what we haven't looked at as yet, and which we'll now take a look at, is the impact on the rental market. So obviously what's been happening with the COVID-19 situation is we've had the workforce essentially is closed down substantially. So amongst job losses, we've also been seeing people that don't have the ability to work from home, that they've had a loss in income via loss of hours, so to speak. And we're finding that has been impacting the rental markets. And more interestingly, it's been impacting certain areas in particular. So at the start of the presentation, you would have noticed that we highlighted that the impact from the economic sense has been felt the most towards and centred around the CBDs, the business centres, the airport precincts with the airport closures, the tourism centres, and at the same time the bushfire affected regions. Now, when we narrow it down to specific areas and regions, the performance is even amplified further. So, Jared, if you just want to talk us through this graph here, that would be great.
Yeah, absolutely, Bradley. We looked at some data from the preliminary listing, which estimated that between the week ending 22nd of March to the week ending 26th of April, the number of properties that went for rent increased 0.8%. So not too bad considering the amount of job losses we had in the last 8 weeks as a whole. But like you said, once you start going to the inner city areas such as Melbourne and Sydney, these areas are affected much more dramatically. And Melbourne and Sydney rental listings RIS 36.2% in Melbourne, and Sydney rental went up 34.1%. So it's to no surprise, obviously in those regions you have relaxed zoning, much higher high-rise apartments, and a higher percentage of renters. So typically these are the markets you do want to avoid. And typically the markets we do avoid when we're helping clients.
Correct there. So another interesting point to mention would be that Melbourne, as an example, has seen a slight, quite a substantial increase in rental listings and increase in rental vacancies, particularly in the inner CBD. But at the same time, it's noteworthy to mention that overseas migration, so the influx of overseas students and things like that, has also impacted upon those markets. So the cumulative effect there is we're starting to see asking rents decline, and more broadly across all markets, we're seeing a similar trend there. So we're seeing a decline in asking rents and downward pressure on yields there. Jared, I do believe that when we were chatting earlier, you mentioned a particular example in Sydney Inner West, in Newtown, about what's happening with some of the trend employment there and rents at the moment. Do you want to?
Yeah, absolutely. What there is, when you drill down on a suburb level, when you look at the demographics of that market, a high percentage of the workforce within Newtown is in hospitality. So obviously with the closures that happened 2 months ago, that was going to have a massive negative impact on the GDP, which it did. And if you look at that, the map that we were looking through later, you can see how much negative impact it actually has. Now, what we've seen as well, as people have been losing their jobs within those areas, there's been downward pressure on the rent, and obviously landlords have had to lower their rents to help tenants through this time. But that's a key reason when we're looking into markets that we always want to ensure diversity is in place, and there's no that suburb isn't overexposed to any one sector, because if something happens to that sector, obviously that can apply downward pressure on that market.
Sure.
Similar to tourism-based destinations, as you touched on earlier, Brad.
That's correct. So that's what this particular graph highlights. As you will see here at the bottom of the screen, this shows the proportion of the workforce employed specifically in the accommodation and food services sector, as well as the art and recreation services sector. So, for example, the Sydney Inner West, in which Newtown would fall in, has around the 15% of the population employed in those sectors alone, and the estimated proportion of people renting in that suburb is 50%. So that's huge. So you can imagine in a suburb like that, the amount of downward pressure on rentals, the amount of increase in vacancies over the period, and with such downward pressure on rental yields, it's actually going to have some downward pressure as well on price growth going forward, because as an investor, it's not going to offer a substantial return. Now we're seeing that. If we look at this particular graph again, as Jared's highlighted there, some of the other regions that are real standout that have a high saturation of people employed in these areas are tourism centres such as the Gold Coast, Sunshine Coast. Hobart is an interesting one as well. I know they're really hurting actually from Hobart's quite big in the Airbnb space. So there's been a surge in rental vacancies because obviously can't Airbnb in the climate of COVID-19, and they've quickly had to try and convert those to a regular tenancy and secure a tenant during this time is quite a large task. But anyway, so with that in mind, we're going to have a look now at the roadmap to recovery. So what has the government announced? And this is the roadmap to opening up the economy as announced by the Prime Minister, Scott Morrison, and also with Josh Frydenberg, the Treasurer. So, Jared, if you just want to run us through the salient points again.
Yeah, absolutely. Really positive, Brad, to see this come through. Look, kids returned to school yesterday, which is good. I dropped a little man there. And it's good to see that now, that activity taking place. And as of tomorrow, we're looking at step one, or phase one. Now, these phases will be reviewed every 3 weeks. And if all goes well, we'll continue to look to relax the social distancing and allow more people to go through to certain businesses and gatherings. So looking at phase one, as of tomorrow, there'll be, you can have 10 people in business and public places, which is great. We're going to see the reopening of restaurants, cafes, and certain shopping reopen again, which is good. Community centres, playgrounds, and boot camps are going to start again, and we're going to see some more local and regional travel take place. So on a economic impact sense, what we're expected to see from this over the next month is 3.1 billion of economic activity, positive activity, and which will help re-engage to some capacity a further 250,000 jobs during that period. So that's really good. Yeah, absolutely. And then looking at step two, if all goes well over the next 3 weeks, then they'll look to enter stage two, which will increase gatherings of up to 20 into your home, businesses and public places. And they'll reopen gyms to some capacity, beauty salons, cinemas, and then they're looking to also reopen caravan and camping grounds. So what that'll obviously have a positive effect on some interstate travel, as people start to travel again and take holidays, especially during school periods. And that obviously will have a flow-on effect to local businesses and people spending again, which is positive.
Agreed.
And once again, yeah.
So just looking at that as well, the economic impact as it stands, Josh Frydenberg mentioned that every month that the current restrictions remain in place, it's costing the government $4 billion. So each incremental step, we're seeing 3.1 billion, 3 billion, and then $3.3 billion in economic gross value added per month. So that's a saving, so to speak, of $900 million and a resumption of 250,000 jobs, 275,000 jobs, 325,000 jobs in the subsequent steps, as you can see there. So quite positive. And with that in mind, we're just going to run through some revised forecasts which have been put forth by some of our panelists there at BIS Oxford Economics. what we're seeing here is that Australia's GDP is expected to climb by 6.7% over the 2019 and 2020 period compared with the 2018-19 fiscal year. Now that's based on the current information available from both the summer bushfires and the current COVID-19 restrictions and the likely flow-on effect there into the economy. So as the COVID-19 roadmap to recovery and reopening of business takes fold, and hopefully, fingers crossed, things go well and we can open up incrementally as outlined in that plan there, we're expecting to see a V-shaped and a rather short, sharp recession, so to speak. Now, the recession refers to once business gets back to business as usual, so to speak, and it resumes, our ability to increase and add GDP output will improve substantially there. So towards the back end of 2021 now, we're expected to surpass growth of 10%. Next, we're going to have a look at the unemployment rate. So during the period, as we've previously discussed, the unemployment rate is expected to reach just on or over 10% towards the end of June this year before it starts to fall away again and reduce in the fourth quarter of 2020 as the plan to reopen business and the roadmap continues to unfold. The long-run impact of COVID-19 on the Australian economy is likely to be small in the long run, so to speak, but it is going to take us a while to get back to the same level of economic output as we were seeing prior to the COVID-19 event. So the early talk or estimates being put forward at this stage is going to take us at least 18 months to get to the level of activity of where we were prior to this event. Now the downturn, it will be relatively short and sharp, but it's not going to be an instant recovery. And the relaxing of those restrictions will enable the larger parts of the economy to get back to work, pretty quickly there. Also, a big key to improving that unemployment and reducing the length and the severity of the recession will be focused around rejuvenating the activity around the CBDs, rejuvenating tourism and those areas such as the employment precincts surrounding the airports and those bushfire related regions. So with travel restrictions likely to remain in place, it's likely that people will choose to do staycations and holiday at home rather than travel abroad and things like that. So we expect to see some rejuvenation in those local economies there. The impact on the property market. So Jared, if you just want to quickly run us through some of these.
Yeah, absolutely. Now, what this is, it reveals a few things, this graph, and some positive signs here, Brad. What we're looking at, if we look at the dark blue bar graphs, you've got stock deficiency. And as always, we're looking for undersupplied markets to potentially look at investing in. So on a macro level, the expectation by 2022 is to see potentially an undersupply, a lack of stock deficiency, which is great, of up to 50,000 short of what's needed for underlying demand. Now, the light blue line, which you can see, and the forecast is to see a little pickup and then sort of flatten out, but it's still remaining strong, which is good. And then in contrast, in the yellow line, we have completions of property hitting the market. Now, the forecast is to see a real sharp drop, which is good before slightly picking up, but by 2022, it's still not meeting the underlying demand, which is perfect. That's what we want. On a macro level, things are looking good come 2022. Then we just need to start drilling down a little bit further into states, followed by cities and suburbs, and making sure that they meet that stock deficiency sense as well.
That's correct. So since 2013, the stock deficiency has been steadily eroding, so to speak, as high-rise multi-dwelling completions, particularly concentrated in CBD capitals around the East Coast and even at a national scale have come online steadily. What we're seeing is since then, the completion rate has steadily been falling away, while underlying demand has been remaining constant with strong migration inflows and population increases just due to natural increases and things like that remaining constant. With the lack of new DAs in the pipeline to fill that void as the I suppose the peak of the construction boom is starting to dwindle away. We expect to see that under supply start to build back up in the coming years, especially into 2022, but it's already going to start increasing it over 2021. So what does that mean for impact on pricing? So forecasts have changed. There's a reduction in the growth rate is expected over the next 6 months. For obvious reasons, there's been a substantial decline in economic activity. It's going to take a while before we actually get back to business as usual. However, by Q4, we're expecting to start to see the return of strong growth rates. With Sydney and Melbourne, as well as Brisbane, expected to increase to 8 to 10% average growth over the forecast period, and that continuing up into 2023. Given the environment and the government signal that restrictions remain in place for the near term, we now expect property prices to fall back in line with capital cities in Q2, although the outlook is highly uncertain, just given what's been happening there with the trajectory of the outbreak and the containment measures. So we also note that a substantial decline in the number of the transactions. The data for the next 3 to 6 months will not be a reliable indicator of the underlying position of the market. So looking ahead, I think the recent monetary policy and loosening from the RBA will be very supportive of activity, low interest rate environment. And as restrictions are lifted, we expect to see a pretty substantial rebound in price growth, probably commencing in 2021.
Absolutely. And like what we see there, that is positive to see that potential upswing, especially in Sydney, Melbourne and Brisbane. Just when we're drilling down and selecting suburbs, we really need to make sure there's strong affordability in place, as well as strong rental yields, to ensure that it's easy to hold the asset, our property, but also that property market has the ability to continue growing. So if anyone needs help when the time comes, we can help with those affordability measures on a suburb level.
Yeah, so we can definitely provide you with a snapshot of the data and how what the fundamentals look like in all the cities and even the suburbs as well. 2020, is it a threat or opportunity, Jared? Yeah,
absolutely. So threat or opportunity, to be honest, I always see opportunity within the residential property market. As I mentioned earlier, I started in 2008, which was an interesting time to get started, GFC. But if you stick to the fundamentals and you take a long-term perspective, you can do well. It's always a long-term play for property. We always want to make sure that the market is offering a strong rental yield to begin with. So if there is flat periods, we know that the property can look after itself with the rental income that's coming in. And we need to make sure that all the drivers, all the fundamentals set a solid foundation, not just for short term. And a lot of people, like looking at a graph there, a lot of people might just quickly jump in Sydney and Melbourne in certain markets with a poor yield just because they see that there's an expectation of 8 to 10% growth. Well, cool, that might go up, but then it might flatline because of the poor affordability that's in place. So we need to take a long-term perspective and make sure that that market has the ability not just to grow in the short term, but the medium to long term. So personally, I think there's plenty of opportunity. We just need to do our due diligence correctly and not jump in too quick. Just make sure we're analysing the market conditions and make sure we're buying well and achieving a strong rental yield.
Yeah, fantastic. So overall, the fundamentals do remain strong, and as business reopens and we slowly get back to some semblance of normality, we expect that underlying demand hasn't gone anywhere, but consumer sentiment should start to bounce back, and we should start to see some movement in price growth. Look, we've reached the end of time. In fact, we've probably gone a little bit over time today, but hopefully you found some value in the content that we've provided in this webinar. If you have any questions at all, feel free to submit some questions in the question box or to reach out to us on the details listed here below. And we're more than happy to go through that with you and give you a call and run through some details, or potentially just send you an email to answer any queries that you may have. But for now, thanks for joining us on this webinar. And thanks on behalf of Meridian and myself, and we'll see you next time.